Okay, so hi everyone, welcome to this episode of WealthAbility Live. My name is Hannah. I help you discover wealth through tax, and because the topic about 100K tax strategy for 100K plus earners become really popular in last couple of tax years. So I think at the beginning of 18-19 tax year, it will be good to bring this topic up front. And in particular, it's early stage of 18-19 tax year, and we can look into some strategies, look into what are the allowances you can take advantage of, especially when you are hitting 100K. And here 100K is your personal income, whether you are salaried or you have an investment or you are self-employed. So everything added up together at exceeding 100K. So first of all, I like to talk about what will happen when you hit 100K mark. And then we'll talk about some strategies. In particular, I like to talk about tax efficient investment. In particular, when you are hitting more than 100K, the tax bill is becoming higher, and you might want to look into some tax efficient investment so that can help you to reduce the tax burden. Okay, so let's start with the basics. And of course, when it comes to the tax rule, apart from certain investment, apart from like buy-to-let property and other allowances, most of the things didn't change that much since 17, 18. So of course, the personal allowance has slightly changed for 18, 19. What will happen when hitting 100K mark? As usual, your personal allowance will start to reduce. So for you will reduce by £1 for every £2 extra earned. So that will be reducing by a tapered fashion. Just a little bit example. For 18-19, the tax-free allowance is 11,850. But if you're earning, your income is 102,000, your personal allowance will reduce by £1,000. So instead of 11,850, your actual personal allowance is 10,850. So that's how it works. And again, there will be no personal allowance at all when you're earning more than 123,700. So that's the basics. Of course, yes, when your personal allowance starts to reduce, that's effectively your tax bill becomes even higher. And not just about that, especially at that stage, you're most likely you're paying tax at 40%. And if you're earning more than 150K, you start paying tax at 40%. So that's again, everything added up together, your tax bill will become really high. So when you're hitting 100K mark. Of course, that's also good news when you're hitting 100K. It means that you're actually adding a very tangible value to the economy. That is the reason why the taxman want to tax you on that. So it can be a badge of honor, but of course there are strategies to help you to mitigate the tax when it's applicable for you and when it's suitable for you. Okay, so and the other obligation is, of course, you will need to submit self-assessment tax returns, even if you're only an employee. So that's a pitfall you need to avoid when you're an employee and you hit 100K. That's an obligation. Okay, so normally, of course, it's a part of a full webinar I normally run. What will happen, there are some strategies. One of them, of course, is pension contribution, but you will need to be aware of the annual allowance. For 18-19, it's still 40,000. And again, it will reduce, the reduction will reduce when you are earning more than 150K. That's again on the tapered fashion. But in terms of pension contribution, it will be, I would suggest always go get a proper independent financial advice in terms of how, like which pension provider to choose from and how much you contribute for the certain tax year. But again, pension contribution can be can be a very good strategy for 100K plus earners. Some other strategy like charitable donations, salary sacrifice, claiming expenses, especially even if you're an employee, and some job-related expenses you might be able to claim. And if you are running a company, and you might need to look at the cash extraction strategies to protect your personal allowance. But again, I think charitable donation, salary sacrifice, and others, these are quite straightforward. These effectively help you to protect your personal allowance. So make sure your taxable income is still just below 100K, and you can still get the full tax-free allowance. So I like to talk about specifically on pension here, how it works. So for instance, I use an example, Dr. Jeremy. He is a salaried GP and working for a private company. And in 1819, the income is 120K. And he only entitled a small amount of personal allowance because he's earning more than 100K. And the tax bill is 40,000. And what's net in his pocket is about 73K. That's also considering the national insurance deduction as well. So if he decide to contribute into pension for 20,000, so first of all, normally your basic rate tax relief is claimed by the pension administrator. So he can get a relief straight away, which is when he contributes 20,000 to the private pension pot, and the taxman make it bigger, make it 25K. So give him a 5K top up in his pension pot. And because he's a high rate taxpayer, he gets another 5,000 tax relief. So yes, he gets 5,000 extra savings from the tax, and then the pension pot becomes bigger, and by just contributing 20K in his private pension. So that's how it works when it comes to pension contribution. Okay, so yes, that's of course pension contribution is one of the low risk, low hanging fruit way to reduce the tax burden, and at the same time you can fund for retirement. And other things you can probably consider, of course, the ISA allowance for 1819, it is still 20,000 for the year, because you can put the money aside, and any money earned either through stocks and shares ISA, or even you just earning interest, these are tax-free environment, so you can put your money aside that to help you to grow gradually in a tax-free environment. Okay, so I think the particular part, the most interesting part I like to talk about today is actually the tax-efficient investments. Probably some of you are aware of things like EIS, Enterprise Investment Scheme, or SEIS, Seed Enterprise Investment Scheme. So these are government incentives to help to encourage the high net worth individuals to invest in UK small and innovative startups, because small businesses are the spine, are the bones of the UK economy. So the government wants more of this, and wants more of these small businesses, especially the ones have innovative ideas, want these ideas to materialize and to really add more value to the economy. So as a reward, the investors get a percentage of the amount they invested, but bear in mind that this can be high risk investments, and it's always advisable to get proper independent financial advice, because first of all, these are the professional advice that can help you to analyze your risk profile and to see whether or not these are the investments you are able to afford. And secondly, the investment financial advisor, they are independent financial advisor, they are able to get access to the funds which are regulated and to help you to mitigate some of the risks. Okay, so let's run through some of them. First of all, it's a venture capital trust. Venture capital trust, which is it's a list companies that are run by fund managers, and they in turn invest mainly in smaller companies that are not quoted on stocks exchanges, but by all means, it means the small private limited companies. And currently, you can invest up to 200,000 per tax year. So for 18-19, that's an allowance, and it hasn't changed. So that's venture capital trust. And how it works, of course, you need to evaluate the pros and cons. You get tax relief. You as investor get a tax relief by 30% of your investments. So that means for every £10,000 you invest into venture capital trust, and you get £3,000 back from the government. So that's a very, very generous tax relief. And you do receive tax-free dividends if the small businesses are performing really well, if they are making profit, and you get the profit share, and these are tax-free dividends. So these are really, really good, especially when you are 100K plus earner. And of course, you don't pay capital gains tax if you sell the shares. So these are actually very tax efficient investments, especially for high net worth individuals, but also need to bear in mind about the pitfalls. First of all, these are high risk investments because you're investing in, of course, it's a fund, but these funds are going to small businesses, and it can be very, very risky because the small businesses, you never know if they are going to succeed or not. And you might get back less than you've invested when the small businesses fail. You might lose your money. Yes, these investments are high risk. You might lose your money. And if you do make a loss, you cannot use the loss to reduce other capital gains or other investments. So that's again the pitfall. If you lose the money, you lose the money. You cannot use that. You can make it further. You cannot use that loss to offset other gains. So that's a disadvantage. And you have to hold the shares for at least 5 years. That means the money has to be tied in for at least 5 years in order for you to keep the tax relief. If you don't, then you lose the tax relief. So it's really the question that whether or not you can afford the specific amount of money and tied in for at least 5 years, and without knowing if you are going to get your investment back or not. So it's really important to evaluate the pros and cons. Yes, the government is giving you generous tax relief, but the question you need to ask yourself is whether or not you are able to afford this. And okay, let's look at another type of tax efficient investment, that is enterprise investment scheme. We also call it EIS. Probably a lot of people are familiar with this. It was launched in 1994, and it is designed to encourage investment in small private companies carrying on the qualifying trade. That means the company has to be doing something very innovative, something that is advance the whole industry and really boost the economy. And again, you get the tax relief based on 30%, which is the same as a venture capital trust. But the investment, you can invest up to 2 million per investor per tax year. So which is this is actually a slightly different than 17-18, because before the maximum investment is 1 million, but now you can invest up to 2 million. But the condition is after the first 1 million, the second 1 million has to be knowledge incentive companies. So again, these are some sort of a technical jargon. That means knowledge incentive companies has to be like very innovative. Things like they have to spend at least 15% of their budget on development, on innovation, on research, to research for the new technology or new things. So that's a brief condition on that. Okay, so that's how EIS works. And again, we need to evaluate their pros and cons. Of course, I think one of the greatest advantage, especially in these days, are for the buy-to-let landlords to defer the capital gain tax, especially because now for 1819, the mortgage interest relief is restricted even further, because 1718 was 75% restricted on 75%, but 1819 is only 50%. So more and more landlords might look to sell their property and reinvest into something more tax efficient. So when they sell the buy-to-let, it is likely they will have a capital gain if they make profits from the sale. But capital gain, that when they make a gain, they will need to pay capital gains tax. But by reinvesting EIS, they are able to defer the capital gains tax. So they don't have to pay capital gain tax unless they sell the EIS shares later on. So, and again, the good thing about EIS is if you've been holding the shares for over 3 years, then you don't even have to pay any capital gain at all. So when you sell the share after 3 years, so that's another advantage. And if you do lose money, which is different from venture capital trust, the investor can offset a loss to other gains or even the income in a year of loss. So if you are earning 100K in the same year and pay tax on that, and the same time you made a loss from the EIS investment, and then you are able to use that to offset. Later on, we have some illustration. And another good thing is inheritance tax relief, because you're holding, as long as you've been invested, you've been holding the shares for at least 2 years, then the company qualifies for business property relief. That means the amount of shares, the assets is outside your estates, and you will exempt from inheritance tax. Okay, so again, EIS is more risky than venture capital trust. That's why I think it gives you more benefits, like capital gains tax deferral and loss relief. But again, it's more risky than venture capital trust, because VCT is a fund and EIS is individual companies. The fund can help you to spread out the risks by investing in different companies, but EIS is investing in individual companies. But again, in reality, for the sophisticated investors, you don't put all your money in one company. So again, you need to hold the shares for at least 3 years to keep your tax relief. And yes, it is high risk and VCT. So yes, we will again run through some examples later on. And before we run through the example, I'd like to talk about one subcategory for EIS, which is called SEED EIS, Seed Enterprise Investment Scheme. So it was launched in 2012. That is designed to encourage even earlier stage the startups by providing tax breaks for backing projects that they may otherwise use as too risky. So it's even riskier than EIS. It is even earlier stage of the startup. Maybe they are just having an idea, but very, very innovative, and they need the money to back up their project to materialize their idea. So investors get 50% of the tax relief. So it's even more. So that means they get £5,000 for every £10,000 invested. And maximum investment is $100,000 per tax year. Okay, so again, it's very high risky. They get the same capital gains tax deferral as enterprise investment scheme. And again, it's a loss relief, but it's slightly different, which we will run through the illustration later on. But how it works is, if the business goes bust, the investors can still claim the loss relief, but it's half of the initial investment multiplied by the tax rate. And again, get the same inheritance tax relief as enterprise investment scheme. Okay, so yes, let's run through the illustration because it's more interesting to get it to know from example. Okay, so Dr. Jeremy sold his buy-to-let property and made a profit from the sale, which is 20,000. If he does nothing and he has to pay capital gain tax at 1,660, which is not too bad because we all have in 1819 there is 11,700 exemptions on capital gain, so which is not too bad. And the net profit is 18,340. But what if he decide to reinvest the 20,000 into like by dividing them half and half, 10,000 go to EIS and 10,000 go to SEIS. Okay, so when it comes to risk analysis, we always look at the worst case scenario and middle ground and the best outcome. So first of all, look at the worst case scenario. If both companies fail, and of course, Dr. Jeremy gets initial tax relief of total £8,000. So for £3,000 from EIS and 5,000 from SEIS. And yes, just imagine if Dr. Jeremy is a 45% taxpayer, and he gets a loss relief of 6,750. So yes, as we mentioned before, if EIS company fail, he can actually offset a loss against his income for the same year, and the same as SEIS, but it's half of the investment. But that calculates at 4,500 from EIS and 2,250 from SEIS, and overall he gets the tax relief of 14,750, of course, given that he has lost all his initial investment. So as we can see, the money he actually really lost was about 3,590, which is not too bad in comparison. In our head, it might be very, very bad, like losing the whole 20,000, but consider the tax relief he has got and the loss relief, so which is not too bad for him. The question is now if he is able to afford, first of all, have the money tied into the schemes for at least 3 years, and secondly, if he's able to afford to lose that 3,590 in total. But so that is a worst case scenario. If he can afford to lose that, and I would say go for it. And again, this is a worst case. How about if both companies break even? So if both companies break even and it's no gain, no loss, but again, Dr. Jeremy got a tax relief of £8,000, and then he is overall is 9,660 better off because he doesn't have to pay the capital gains tax, and over the return is yes, he gets to keep the £8,000, and then he doesn't have to pay the capital gain tax, which is 1,660. So in total, he is 9,660 better off. And let's look at the best case. Well, not really best case, because making profit can be unlimited potential. So if both companies making profits and the value of shares has doubled, so what could happen is Dr. Jeremy gets the initial tax relief, and if the investment doubled, he gets 20,000 in return. So overall, he gets 29,000. He is 29,660 better off. That's considering the capital gain tax deferral. So he made more than like his initial investment. So overall, as we see, the worst case scenario, which is he losing 3.5 grand, which is not too bad. And if he is able to lose that much, then I would say go for it. In reality, it might not be that bad. And also other things he can consider to mitigate the the risks is really get a proper independent financial advice. And again, let's summarize considerations on the VCT and all these kind of investments. Of course, you need to evaluate how much you are able to afford to lose, and never put all the money in one investment or one individual companies. And also never use this type of investment for the sole purpose of avoiding tax. I would say don't let the tax tail wag its dog. At the end of the day, you want the money to work for you in the right purpose. Of course, if you are having genuine interest in small businesses, you really want to see more of the UK businesses to grow, then this will be the type of investment that you can look into. And also money will be tied in for at least 3 or 5 years. So it might not be an option if you need the money for short term. And also when it comes to EIS and SEIS, yes, these are investing in individual companies, but they are portfolio management platforms out there that are managed, and also they do all the heavy lifting for you. Imagine if you are to invest into the company that you completely have no knowledge of, you will need to do a lot of research on that company. But having this managed platform, these are the people already done all this work for you. So it really help you to make your life easier. And again, I would always advise to seek for independent financial advice if you're really looking into this type of investments, and to make sure your investment is aligned with your value, and make sure your money is growing with the right purpose. Okay, so that is what I like to share for today. Just a little bit summarize. We talk about the tax considerations when you are hitting 100K. That is, you start losing personal allowance. We went through some strategies, things like a pension contribution or other things like charitable donations that keep your taxable income below 100K to protect your personal allowance. And most importantly, we run through different type of tax efficient investments, especially the illustration and what you need to consider when it comes to investing in these type of schemes. So I hope you find this one useful. And of course, by all means, if you do need more advice on your taxes, on your tax bill, or any tax strategies, I do provide tailored tax advice to my retainer clients. So I will put my contact details as well as ways to get in touch with me, to get into the discovery session with me. The link I will put into the description box below if you're watching me on YouTube. So you can get in touch with me. And by all means, I hope you enjoy this one, and I hope you I hope you have a nice day, and I shall see you very, very soon.